In this video, we analyze Chapter 4 of the Intelligent Investor book. Warren Buffett has called this the best investing book ever written, so every serious investor should understand it in depth. In this chapter, Benjamin Graham explains how the defensive investor should construct his portfolio. Hi, I am Nick, the guy with the Greek accent, a long-time value investor and financial educator. And to my fellow intelligent investors, stick with me, and by the end of this video, you'll know exactly how to build a portfolio that protects you from both crashes and your own emotions. Let's start. On page 88, Graham writes something very important. It has been an old and sound principle that those who cannot afford to take risks should be content with a relatively low return on their invested funds. From this, there has developed the general notion that the rate of return which the investor should aim for is more or less proportionate to the degree of risk he is ready to run. Our view is different. This is gold, and in my opinion, one of the most important ideas of the whole book. Let me break this down. Most investors believe in a simple rule. If you want higher returns, you must accept higher risk. Want to play it safe? Then accept lower returns. This idea is everywhere, from financial advisors to university textbooks. It seems like common sense. But Graham directly challenges this. He says this popular belief is wrong. And that's incredibly bold. He is disagreeing with one of the most fundamental principles in all of finance. Wall Street has built entire theories around this risk-return relationship, and Graham is saying, no, you've got it backwards. So, what does Graham believe instead? He continues, the rate of return sought should be dependent rather on the amount of intelligent effort the investor is willing and able to bring to bear on his task. The minimum return goes to our passive investor, who wants both safety and freedom from concern. The maximum return will be realized by the alert and enterprising investor, who exercises maximum intelligence and skill. This changes everything. Graham is saying your returns shouldn't be based on how much risk you are willing to take. They should be based on how much work you are willing to do, how much time and intelligence you are willing to invest in your analysis. He gives us two clear paths. Path 1, the defensive or passive investor. This investor doesn't want to spend time analyzing securities. He wants safety and peace of mind. Graham believes this is perfectly fine. Here is what you do. You follow a simple, proven strategy that requires minimal effort but still gives you adequate returns with real safety. That strategy he is explaining in chapters 4 and 5. Path 2, the enterprising or active investor. This investor is willing to put in serious work, deep research and careful analysis, and through that effort, not through taking wild risks, he can achieve superior returns. He finds opportunities the market has missed. Now you have to decide. Are you willing to put in the effort required to be an active investor, or do you want peace of mind? That decision dictates your results. He then continues by explaining what the defensive investor should do. We have already outlined in briefest form the portfolio policy of the defensive investor. He should divide his funds between high-grade bonds and high-grade common stocks. First of all, notice that Graham believes the defensive investor's portfolio should only have two asset classes, high-grade bonds and high-grade common stocks. Nothing else. No junk bonds, no preferred stocks unless bought on a deep bargain basis, no commodities, no gold, and if Graham were writing today, certainly no crypto or options. Keep in mind some of these instruments like cryptocurrency didn't even exist in Graham's era, but his principle remains clear. Defensive investors should stick to only the highest quality bonds and stocks. Now let's look at Graham's specific allocation formula. He writes, We have suggested as a fundamental guiding rule that the investor should never have less than 25% or more than 75% of his funds in common stocks, with a consequent inverse range of 75% and 25% in bonds. There is an implication here that the standard deviation should be an equal one, or 50-50, between the two major investment mediums. So the baseline is simple: 50% stocks, 50% bonds. But you have flexibility. You can go as high as 75% stocks if you want more growth, or as low as 25% stocks if you want more safety. The key is you never go to the extremes. Never 100% stocks, never 100% bonds. You always stay balanced. But here is where it gets interesting. Graham continues. According to tradition, the sound reason for increasing the percentage in common stocks would be the appearance of the bargain price levels created in a protracted bear market. Conversely, sound procedure would call for reducing the common stock component below 50% when, in the judgment of the investor, the market level has become dangerously high. So Graham is saying, when stocks are cheap after a market crash, shift toward 75% stocks. When stocks are expensive in a bull market, shift toward 25% stocks. Buy low, sell high, applied to your allocation. Sounds simple, right? But then Graham admits something crucial. These copybook maxims have always been easy to enunciate and always difficult to follow because they go against that very human nature which produces the excesses of bull and bear markets. It is almost a contradiction in terms to suggest as a feasible policy for the average stock owner that he lighten his holdings when the market advances beyond a certain point and add to them after a corresponding decline. It is because the average man operates and apparently must operate in opposite fashion that we have had the great advances and collapses of the past, and, this writer believes, we are likely to have them in the future. This is profound. Graham is telling us the truth. This strategy is psychologically brutal. When stocks are soaring and your friends are making money, the formula tells you to sell and buy boring bonds. That feels terrible. And when the market crashes and financial news is apocalyptic, the formula tells you to sell safe bonds and buy falling stocks. That feels terrifying. This is why most investors fail. They do the opposite. They get excited and buy at the top. They panic and sell at the bottom. It is part of human nature, a part of you and me. So Graham is saying, human nature creates bubbles and crashes. Always has, always will. The defensive investor's edge, a mechanical rule that overrides emotion. The 50-50% guideline doesn't care how you feel. It just keeps you disciplined. He writes, we are thus led to put forward for most of our readers what may appear to be an oversimplified 50-50 formula. Under this plan, the guiding rule is to maintain as nearly as practicable an equal division between bond and stock holdings. So Graham thinks that for most defensive investors, a 50-50 split is the way to go. But he goes one step further. When changes in the market level have raised the common stock component to, say, 55%, the balance will be restored by a sale of 1/11 of the stock portfolio and the transfer of the proceeds to bonds. Conversely, a fall in the common stock proportion to 45% will call for the use of the 1/11 of the bond fund to buy additional equities. Start with 50-50. Then just check your portfolio twice a year. If stocks have done well and now represent 55% of your portfolio, you sell some stocks and buy bonds to get back to 50-50. If stocks have fallen and now represent only 45%, you sell some bonds and buy stocks to get back to 50-50. Notice what this does automatically. You are selling stocks when they have gone up. You are buying stocks when they have gone down. You are mechanically following the principle of buy low and sell high, without having to make emotional judgments about whether the market is too high or too low. The beauty is that it takes the decision out of your hands and bypasses emotions completely. You don't have to predict the market. You don't have to fight your emotions. You just follow the math. When your allocation drifts 5% in either direction, you rebalance. Simple. Next, Graham explains the different types of bonds that exist and which ones the defensive investors should choose. I won't go into all the details here, but there is one critical principle you need to understand. When choosing bonds, don't just look at the yield. You need to calculate what you actually keep after taxes. Graham emphasizes that tax-free municipal bonds often beat taxable corporate bonds for investors in higher tax brackets, even though their stated yields look lower. Here is the simple math. If a corporate bond pays 5%, but you are in a 30% tax bracket, you only keep 3.5% after taxes. But if a municipal bond pays 4% tax-free, you keep the full 4%. The municipal bond wins, even though the number looks smaller. This principle is just as relevant today as when Graham wrote the book. Now, before we move on to common stocks, Graham includes something interesting in this chapter, a discussion on preferred stocks. You might wonder why he discusses them alongside bonds rather with common stocks. The reason is simple. Preferred stocks are much more like bonds than stocks. They pay fixed dividends with no participation in company growth, just like bonds pay fixed interest. But here is Graham's warning. He writes, really good preferred stocks can and do exist, but they are good in spite of their investment form, which is an inherently bad one. The typical preferred shareholder is dependent for his safety on the ability and desire of the company to pay dividends on its common stock. And his conclusion is blunt. In other words, they should be bought on a bargain basis or not at all. What does this mean? Preferred stocks gives you the worst of both worlds. You don't have the legal protection of a bondholder. The company isn't legally required to pay you, but you also don't have the profit potential of a common stockholder. You are stuck with a fixed dividend and no upside. For defensive investors, Graham's advice is clear. Skip preferred stocks. Stick to high-grade bonds and high-grade common stocks. Before we check the modern commentary by Jason Zweig, I want to say one thing. Well done. We live in an age of AI slop and shrinking attention spans. But you are still here. That sets you apart. As Charlie Munger famously said, I did not succeed by intelligence. I succeeded because I have a long attention span. By sticking with this deep analysis, you are proving you have the focus required to build real wealth. So, give yourself some credit. You are building a massive edge. Back to our analysis. On page 102, Jason Zweig writes, the most striking thing about Graham's discussion of how to allocate your assets between stocks and bonds is that he never mentions the word age. That sets his advice firmly against the winds of conventional wisdom, which holds that how much investing risk you ought to take depends mainly on how old you are. A traditional rule of thumb was to subtract your age from 100 and invest that percentage of your assets in stocks, with the rest in bonds or cash. And then he adds, why should your age determine how much risk you can take? Think about how rigid that old rule is. It assumes that just because you are young, you can afford to lose money, and just because you are old, you must be terrified of the market. Zweig calls this nonsense. He argues that your asset allocation shouldn't depend on your birth date, but on your financial circumstances. The market doesn't care how old you are, it only cares about how much capital you can afford to lose without panicking. To prove this, Zweig gives us two powerful examples that flip the script. Imagine an 89-year-old widow who has millions in the bank and lives with very little money. She doesn't need the income to survive. Her portfolio is actually intended for her grandchildren. Even though she's old, her investment horizon is actually decades long because the money is for her heirs. Therefore, she can afford to be aggressive and hold mostly stocks. Now compare that to a 25-year-old who is saving for a down payment for a house next year. According to the age rule, he should be 75% in stocks because he is young. But if the market crashes 30% tomorrow, his down payment is gone and his dream of buying a house is destroyed. He literally cannot afford that risk. So the lesson here is clear. Don't look at the calendar to decide your portfolio. Look at your cash flow needs. If you need the money in the next few years, stay defensive. If you don't need to touch it for decades, that is when you can afford to be aggressive. Next, I want to point out the following passage. I suggest that you rebalance every 6 months, no more and no less, on easy to remember dates like New Year's and the 4th of July. The beauty of this periodic rebalancing is that it forces you to base your investing decisions on a simple, objective standard. Do I now own more of this asset than my plan calls for? Instead of the sheer guesswork of where the interest rates are heading or whether you think the Dow is about to drop dead. This advice is practically a psychological superpower. By answering your rebalancing to specific dates like the New Year's and the 4th of July, you remove the temptation to time the market based on fear or greed. You stop worrying about interest rates or election results and simply ask one mechanical question. Did my allocation drift? If your stocks are up to 55%, you sell. If they are down, you buy. This shifts your focus from external noise you can't control to the one thing you can control, your portfolio mix. The last passage I want to share from the commentary is this. No intelligent investor, no matter how starved for yield, will ever buy a stock for its dividend income alone. The company and its business must be solid, and its stock price must be reasonable. This is a crucial warning, especially today. Zweig is describing what we now call a yield trap. It is very tempting to see a stock offering a 8% or 9% dividend and think, wow, easy money. But you have to ask yourself, why is the yield so high? Usually it is because the stock price has collapsed because the business is in trouble. Think about it. If a company paid a $4 dividend and the stock was $100, that's a 4% yield. Now the stock drops at $50. Suddenly, it's an 8% yield. But nothing improved. The business got worse, and the dividend is likely about to be cut. If you buy a stock only for that juicy dividend, but the company slashes the payout and the stock price keeps tanking, you lose far more in capital than you ever gained in dividends. Graham's rule is absolute. The business quality comes first. The dividend is just the reward for owning a healthy business, not the reason to buy a sick one. So, if you take only 3 things from this video, make them these. Effort equals return. Stop thinking you need to take crazy risks to make money. Graham teaches us that superior returns come from hard work, not high risk. If you want the passive life, accept the standard return. The 50-50 answer. Graham's default is clear. 50% stocks, 50% bonds. It is not sexy, but it keeps you safe when the world goes crazy. Rebalancing is your contrarian superpower. Everyone tries to predict the market. You ignore predictions entirely. Twice a year, New Year's and 4th of July. Pick your days. You simply restore balance. Stocks outperformed. Sell some. Bonds outperformed. Sell some. You are mechanically buying low and selling high. while everyone else does the opposite. The magic isn't in the dates, it is in having a rule so simple that your emotion can't argue with it. We have built a fortress of the defensive portfolio today, but the strategy isn't complete. In the next video, we analyze Chapter 5, where Graham gives us the exact, no guesswork criteria for selecting the stocks that belong inside your portfolio. To ensure that you don't miss that crucial next step, subscribe now. And if you just joined us, click the playlist link to start the entire Intelligent Investor series from the introduction and master the foundations of value investing. Thank you very much for watching, and as always, invest wisely.